Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
All right, let's get started. The document we're working from today is the U.S. Market Peripheral Notes, dated Monday, April 6, 2026.
This video presents a direct informational narration of the source document.
So here's our roadmap. We'll start with the macro backdrop and this idea of an island open. Then we'll dive into the geopolitical game between the U.S. and Iran. After that, we'll check what the crude oil market is signaling and how that's creating tension for monetary policy. From there, we'll do a sector readout and finish up with the core conclusion and the forward watch list.
Okay, first up, the macro backdrop. The report uses this fantastic phrase, an island open, to describe the market on April 6th. You see, with global holidays in effect, markets in Europe and most of Asia were closed. This left U.S. equities as the only major liquidity provider, essentially a lone island in a liquidity desert.
So, what was happening on this island? Well, the core indicators show a market in a holding pattern. The index posture was a tight, narrow range, a real tug-of-war right near the year line. The VIX fear gauge held steady around 24, which tells us there wasn't any disorderly repricing going on. And interestingly, comments from Trump about a rescue operation had a diminishing market impact. The bottom line is that the recent aggressive deleveraging seems to be largely complete.
Now this brings us to Section 2, the geopolitical game. At this point, the U.S.-Iran standoff was entering its 6th week. The initial shock had passed, and the situation had settled into what the document calls a positioning vacuum, with both sides holding their ground.
Behind the scenes, mediation efforts were being led by Pakistan and Turkey. The proposal on the table was a two-stage process. Stage 1 involved a 45-day temporary ceasefire, which would allow for the reopening of the Straits of Hormuz and, critically, the launch of permanent peace talks. Stage 2 would be the signing of a permanent geopolitical security agreement.
But here's the disconnect. The mediated proposal was built on a temporary ceasefire as a condition for talks. Iran's stated demand, however, was a rejection of any temporary ceasefire. They were demanding formal sovereignty and a permanent end to the conflict right from the start. That's a pretty severe standoff.
So, why was the market so resilient in the face of this? Well, the document points to two layers of internal logic. First, there was both an earnings safety cushion and a macro buffer. In fact, aggregate earnings expectations had actually been revised up by 4% since the conflict began, supported by strong economic data. But the second layer is really about game theory. The market was operating under the expectation of a limited strike, one that would lead to a face-saving agreement where each side claims victory. Which brings us to our third section, crude oil. The report frames the oil market as the ultimate geopolitical lie detector. It's the one place you can look for a reality check on what's actually happening with the Strait of Hormuz.
And the key signal the oil market was sending is a condition known as backwardation. It just means that the price for oil in the future is trading below the spot price today. In this context, it tells us that traders expected the current supply tightness and the risk premium to ease over time.
And we can see this reflected in the field monitoring data. Before the conflict, the normal traffic volume through the strait was about 135 vessels per day. Over this weekend, the observed level was just 21 vessels over 2 days. So, while passage was limited, the fear of a complete shutdown had eased. The report also includes a very direct institutional credibility warning. Quoting from the text, this report remains highly skeptical of Citronine Research's claim. Its research style tends to manufacture emotional shocks in low liquidity windows. Investors should classify it as a sentiment tool rather than a reliable research source.
Let's move on to Section 4 and the tension this is all creating from monetary policy. Sustained high oil prices are causing a major contradiction between the 10-year Treasury and core inflation expectations.
The critical focal point has become oil staying above $100 per barrel.
And in response, the 10-year U.S. Treasury yield remains anchored at around 4.3%, with the market effectively pricing out further rate cuts. This sets up two potential scenarios. The first is a delayed cut scenario. If oil falls back below $100, the logic for rate cuts is likely just delayed, not canceled. But the second scenario is the real asymmetric risk, a stagflation script. If oil remains above $100, it could trigger a stagflation regime, the most feared outcome for equities. And Friday's upcoming CPI report is the key test for this. So, moving to Section 5, let's look at the sector level. The report notes that, as a key administrative risk dissipated, the managed care segment has shown defensive strength. This is because of the reversal in the final CMS rate for the 2027 Medicare Advantage program. The initial proposal in January was for just 0.09%. The final decision in April came in at 2.48%, a significant upward revision.
In contrast, the report points to Tesla, which exhibited a gap up and fade pattern. Its key technical levels are identified as hard resistance at $363 and a psychological support zone at $300. Okay, let's wrap this up with our final section, the core conclusion and forward watch list. The report's conclusion is that the market is in an awkward equilibrium. And, to quote directly, no real downside momentum because deleveraging is largely complete, but no real upside confidence because the fundamental picture remains blurred. So, the watch list for this week has 3 key observation nodes. On Tuesday, April 7th is Trump's final deadline. The thing to monitor for is a limited military move followed by a face-saving agreement. Then on Friday, we have the CPI data release, which will be a key test for inflation pass-through. And in the coming weeks, earnings season begins, which should shift the market's focus back to corporate return on equity. Finally, the strategy anchor. The advice is to stay aligned with that medium-term, each side claims victory game theory view. And in terms of positioning, that means prioritizing defensive sectors with a hedge against administrative risk, like the managed care space.